Have the private markets, have the valuations actually come down? Are all of these venture capitalists and private equity folks marking their books properly to reflect this new world?
It's a great question. So I can tell you what we do, which is we mark to whatever the last valuation was. But if a portfolio company of ours hasn't raised in the last 12 months, we automatically mark it down because the assumption is they most likely haven't gone to market because they're not confident in what they would get in terms of term sheets and offers. So, yeah, I know that we have certainly done a pretty conservative markdown on our portfolio. But overall, as we see deals coming in, and look, we're Series A and seed investors who are pretty early stage, are valuations lower and more reasonable than they were in 2021? Yes, but are they exponentially lower? No. I mean, what's really changed is, in 2021, when things were really crazy, I'd get on the phone with a founder and then I'd be told as soon as the call ended that if I was interested, I had to submit a term sheet in 20 minutes. Whereas now we have more leverage, we have more time, and we can really do our diligence.
Bradley, can we talk about that? Let's just talk about that idea that you would have to file a term sheet or submit a term sheet in 20 minutes. Because to me, the idea of that in a way connects, and I know you're not connected to it, but connects to FTX, connects to the collapse of some of these firms. And Brian had asked at the top of the 6 o'clock hour, what about all the venture capitalists? Didn't they do diligence? Couldn't they see what was going on? And I said, look, the truth is, and I'm curious if you agree with this, most venture capitalists aren't doing meaningful diligence because part of the business model, for better or worse, is we're going to strike out a lot and we're going to hope we hit a couple of home runs along the way. And as part of that strikeout process, we're going to miss some stuff. And that is the cost of the way our model works. Don't look at us to be the policeman. I'm not saying that's right, but I think that that's what's happening.
Yeah, so that's definitely the mentality, especially for early stage investors. Just the rule of thumb is a third of your deals will go to zero. Hopefully a third will be significant hits and a third will at least get you your money back. And that's what makes the math work. But yeah, I mean, part of the problem is that that's not the business they're in. And the other problem is so much venture money has been raised that they've got to deploy it, right? And not only do they have to deploy it, but if you have a $600 million Series A fund, you can't really write $2 and $3 million checks. You got to write $10 million checks, $15 million checks. So all of that artificially inflates the value of a company. And then it continues all the way down the line into the growth equity funds and everyone else. And the only time reality finally sets in is when these companies go public. And then the markets generally rightly cut the valuation significantly back down to what it should be. But we're in this cycle.
So help me with this, though. The public is, I think, rightly upset, frustrated, mad, angry at what has happened at FTX. But they also believe that the venture capitalist firms and the financiers around it were complicit and therefore responsible for all of this. Inside those firms, however, they look at it as a write-off and something that is a tiny part of a larger fund. And so I don't think that they see it the way perhaps the public or maybe the customers see it.
Well, yes and no. So yes, I think you're right. The business model is just kind of, you got to shake it off and keep shooting for sure. But look, Sequoia has some significant egg on their face over their both FTX investments and the way that they touted and talked about Sam Bankman-Fried. You saw them apologize to investors. I suspect that on the next deal like this, they're going to do more diligence and be a little more careful about it. And because Sequoia is the gold standard of venture capital, that trickles down to everybody else as well. So I think we'll see a little better diligence. But you're right. I mean, this is a business of just taking shot after shot after shot and hoping that a few hit and knowing that the FTXs of the world are going to happen sometimes.
Okay, final question, because I know we're running out of time, but we haven't said the two words Elon Musk this morning yet.
Yeah, I'm amazed that we made it this long.
What do you think?
I think he's got to be a little careful because look, Tesla's market cap, I looked a couple of days ago, was $564 billion. General Motors is $56 billion. General Motors sold 2,200 cars last year. Tesla sold, 2.2 million. Tesla sold about 900,000. So a lot of Tesla's valuation is based on hype. It's based on sort of promise and potential, but it's based on this belief that Elon Musk can't fail, right? And then all of a sudden, if he does fail, if he can't rescue Twitter, and it seems like he's having a pretty hard time doing so, what you have to worry about is the investors say, you know what, is Tesla a little bit of a house of cards? Should SpaceX be valued as high as it is? What about Starlink, Hyperloop? Musk has all of these companies and he benefits from the hype machine maybe more than any business person in history. And as a result, he's doing something really public right now. And if it fails, he runs the risk of it bleeding onto everything else he does.
So you're the venture capitalist. Would you bet he succeeds or fails?
I so far would bet fail only because I've yet to see a new idea come out of him or his team that's particularly interesting. Every idea they've had for monetizing Twitter is just, oh, well, we'll do more e-commerce or, we'll sell more ads or whatever it is. It's all the same old stuff. If they come up with something truly new and inventive, sure, I'd bet on Elon Musk. But they need to have better ideas than they do so far.